Hi friends, today we will discuss on Equitas Small Finance Bank's Q3 results. So before we start, a quick disclaimer. I'm not a SEBI registered analyst, so any stocks or shares which we are discussing in this video is purely for educational purpose. Please do not consider it as a buy or sell recommendation. So Equitas Small Finance Bank has undergone a structural transformation, successfully shedding its image as a monocline microfinance lender. So this diversification is the cornerstone of its current valuation as it creates a more resilient balance sheet capable of weathering interest rate cycles. The loan book is now strategically distributed with small business loans of 41%, vehicle finance of 23%, and microfinance reduced to 12%. This 88% non-MFI mix is a defensive mode. By focusing on high-touch segments like SBL and used vehicles, Equitas utilizes its operational intensity as a competitive advantage that larger universal banks struggle to replicate. The bank operates 1,053 banking outlets across 18 states, supported by a workforce of 28,451. And in this headcount, it has grown from 24,238 in 1 year, a 17% increase. While management labels this investment as a specialist, I view this as a significant fixed cost burden that necessitates aggressive volume growth, avoid margin dilution. And the bank's unit economics are currently being reshaped by a deliberate pivot toward used assets and a recalibration of the MFI repayment engine. And in terms of GNPA, under microfinance segment, it is having around 6.62% and in SBL 3.04%. Housing finance is around 1.04%. Vehicle finance is around 1.90%. MSC finance is around 3.48%. So the strategic pivots, vehicle finance provides yield protection. The new CV advances fell 26% year on year, while used CV and used cars grew 23% and 36% respectively. This is a deliberate yield protection strategy adopted by the Equitas Small Finance. New CV is a price sensitive, low margin business. Used assets provide higher spreads and leverage the bank's superior repossession and collection network. It's MFI structural shift. 63% of MFI book is now on monthly repayment. Aligning repayments with borrower cash flows has pushed its bucket efficiency to 98.99%. However, the increase in new to bank customers to 47%, 18% quarter on growth introduces seasoning risk that must be monitored. The company's strategy of delivering on liability 2.0 initiative is a engine behind the bank's NIM expansion. By narrowing the cost of funds gap with larger peers, Equitas is evolving into a new retail franchise. At a granular level, if you see the deposits, the retail deposits constitute 73% of the total mix, including 49% savings account balances are in the 1 lakh to 1 crore bracket, indicating a high quality mass affluent base. And its CASA remains stable at 30%, which is equivalent to 12,886 crores, a commendable feat in the high interest rate environment where competitors are seeing CASA erosion. And if you see the cost of funds trajectory, it dropped from 7.49% to 7.13% year on year. This 36 basis points reduction was achieved by aggressive rationalization of SA rates now at 5.24% and term deposit rates at 8.08%. The mobile 2.0 app and products like Elite Lite and Ardha are the primary tools for self-service mobilization, aiming to further reduce the cost of acquisition. The company generated net interest income of 852 crores uh, and total operating expenses of 829 crores with a PAT of 90 crores. Cost to income is around 70.37%. So it's if you do a NIM bridge analysis, quarter on quarter movement, NIM expanded by 43 basis points from 6.29% to 6.72%. Yield on advances, 38 basis points increase driven by higher interest income. And deposits, 19 basis points, savings from cost of funds reduction. If you see the adjusted PAT, excluding the non-recurring 29.52 crores liable provision, would be approximately 112 crores. And in terms of inorganic growth, disbursement grew 28% year on year. However, MFI disbursements included 1343 crore agri as a DA purchase. Without this inorganic push, disbursement growth would be significantly lower, suggesting the organic MFI engine is still in low gear. And in terms of cost to income skepticism, management claims the 70.37 CEI ratio is an investment. Given the 4,213% headcount increase year on year, the bank is dangerously close to operating bloat if advances growth does not accelerate. If we see the asset quality and risk management, the company is having opened a GNP of 1,081 crores, and it recorded a net slippages of 246 crores and write-offs of around 157 crores. And it sold its NPS to ARC of around 54.85 crores in Q3 fiscal year 2026. So the sale of 54.85 crore of NPA assets to an ARC was a strategic move to manage perception and reach the 2.62% headline GNPA figure. Without this sale and the 157 crore write-off, the asset quality picture would be markedly more stressed. And its PCR, which is nothing but provision coverage ratio, stands at 67.1%. And Equitas provides 100% for unsecured substandard assets versus the 25% IRAC norm, reflecting a conservative risk posture. And if you see the currently the bank is valued at around 1.31 times of the price to book ratio, which is fair given the 0.65% ROA, but cheap if the 1% exit target is met. And well, let's do a basic valuation exercise. On a base case scenario, if the company grows, the bank grows by 15% growth, maintains 1.8% credit cost and cost of funds at around 7.1%, you can have an ROA of 1%. In a bull case scenario, if the growth is 20%, and if MFI recovery and cost of funds is stay less than 7%, then we can see an ROA of 1.3%. And in a bear case scenario, if SBL slippages in Karnataka and cost to income ratio is greater than 72%, MFI yield drops, the ROA will reach at 0.45%. And if you do a basic SWOT analysis, its strength is 82% secured book, 51% MFI principal, credit guarantee fund for micro units covered, and 73% retail deposit mix. And weaknesses, high cost to income ratio of 70.37%, geographic concentration, wherein it is having exposure of 50% MFI in Tamil Nadu itself. Opportunities, used car growth is growing by 36%, and gold loan expansion. And in threats, Karnataka's SBL slippage, which is a localized risk, and regulatory changes in MFI lending norms. So, uh, key monitorables in this is conviction in the 1% exit ROE is moderate to high. But we need to track these key monitorables like Karnataka SBL slippage, MFI yield trajectory, headcount efficiency, and cost of funds. These are the major things to be tracked in this company. If you like the video or analysis, please like, share, and subscribe to my channel. Thank you.